Yo, what's going on, everybody? It is Friday, June 16th. I'm coming to you here from sunny Florida. I tell you, I'm getting used to this weather pattern, man. It's like freaking beautiful. I joined the gym, waking up at 4 o'clock in the morning, but now it's like not walking. Unfortunately, it's like not taking the elevator down to street level in my building. I got to drive 7 minutes. But it's a real workout gym, like the kind I used to grow up in, with like pumped up, juiced up bodybuilders and weights, as far as the eye can see. So it's pretty cool. And it's a 24-hour gym, so that's cool. Anyway, let's talk about the markets. So yesterday we had a big up day, and that was the tax drain day, which I've been warning about. And a lot of people were asking me, hey, Mike, where's this tax drain? Like, when is it coming, And the numbers show that yesterday there was a 48 billion drain. I think, and that compares to, I looked up back in March, it was like a 53 or 54 billion drain. So far it's a little bit less, but I suspect the drain will continue over the next few days at least. And we had a pullback today, and I still see that continuing, as we go through this tax drain. So I don't think it, it just looks like, to me, it's not going to be that deep of a sell-off, because sentiment now, it's weird because sentiment is like mixed. Like, you're still getting these headlines about there's going to be a recession and the Fed went too far and and all this stuff, like the same monetarist bullshit that we've been hearing for 15 months. But on the other hand, you're also hearing or seeing headlines saying like they're not so worried about recession anymore. And really, that's the key thing, is that these, like I've been saying, these leading spending flows are very, very high, although they dropped down recently, but they'll pop back up in the second half of the month. So, we're talking about a 560 to a 600 billion monthly spending flow. I just don't see that as a level that is weak enough to cause a recession. We're not going to be growing at 10% or 7%. We'll be growing like at, 2.2, 2.5%. But inflation is coming down. The Fed paused. So these monetarist zombies are going to stop, hyperventilating over every Fed meeting, because they're going to pause now probably for a while. We're seeing it in the numbers. The only thing, like I said last time, the only thing inflationary is what the Fed has done with its own rate increases, which has been hitting like housing and rental markets and autos and stuff like that. But bank data is still pretty good. We're seeing loan expansion at a slower pace, but I don't see any change in the paradigm right now. I don't see any change in the trend. I just see it as, it's a slow, moderate pace of growth. And that's the thing you got to focus on, is growth. If there's growth, that also means profit growth. And the profit growth means that the stock market is going to go up. Like I've always said, like, it's not the stock market that leads the economy. People think it's like it's the economy, stupid, right? The economy leads the stock market. If the economy is growing, then people earn more money, businesses earn more money. It's a question of the rate of growth. Like, if it's slow, yeah, then everybody feels like sluggish and stuff like that. But nevertheless, it's still growth. When there's a real contraction, which is in place for a long period of time, everybody's losing money. It's being sucked out. It's being drained out into the coffers of the government. One thing that I noticed was a headline that U.S. manufacturing is booming, all right? This is classic. We've been talking about de-dollarization, and people think like, Japan or China, they're going to sell their dollars. But somebody else is buying them. That's not de-dollarization. De-dollarization, and I've said this in the past, is when foreign holders of dollars exchange their dollars for goods and services or capital investment in the United States. And that's what's causing the expansion or the boom, they're calling it, in factory production. Like, we're seeing an influx. This is how the foreigners are getting rid of their dollars. It's an influx into the United States, into production. And those goods are going to lead to more exports. And that is going to bring down the trade deficit ultimately. A big part of that, of course, is oil and refined petroleum products. But that's been slowing down, but I think that's a pause in the trend. But this is what happens, and people have been talking about this kind of like from both angles for a long time, like, the dollar's going to crash, or what happens if we lose, the dollar as the reserve currency. That's not going to happen in a long time, but it may be on that track. And we're going to see 10 years from now, people saying, hey, we need to manufacture here, we need to produce more. That's true. If it's happening as a result of, this de-dollarization, I'm telling you right now that 10 years we'll look back and we'll see that the standard of living of Americans will have gone down. Yeah, they'll have factory jobs and stuff like that, but it's the standard of living is based on what you have, your things. It's based on where you live, what conveniences and things you have, that capital, just physical capital and assets that you have. That's a testament to, or that tells you a nation's standard of living. It's very easy. Your eyes don't lie to you. I mean, if you go to some African countries that are really, really poor, what do they have? Dirt roads, no medical facilities, no clean water. I mean, that you don't have to be, nobody has to explain to you that that's a lower standard of living than what we have here in the United States. But when we produce goods and we sell them out, we give them to foreigners for their currency, we become net savers in whoever is ending up buying. I'm noticing, I said this, and a lot of people took issue with my claim that it could be the euro area. I mean, I see the euro area surplus is coming down, and they're doing a lot more business, with now China and stuff like that. And I don't know. We'll see. All I'm saying is that if you're a trader right now with this tax drain, then I think you got to be long the dollar, because that's going to be beneficial. But after that, I think the dollar, once this tax drain gets replenished, and it could take a few weeks. Usually these corporate tax drains are not as big and consequential as the April 15th, when everybody has to pay their taxes. But during this period when we have this drain, I think the dollar can go up. And then I think, we could enter into a period after that where the dollar resumes its downtrend. But, so that's the update here from Florida, folks. Remember, go to our website, pitbulleconomics.com. Sign up for a 30-day free trial. Forget the chart fairy, okay? I'm tired of talking about it, but if charts were the answer, folks, then everybody would be rich. Charts are not the answer. The answer is understanding the macro picture, which means knowing what's coming next. Not, again, if you're a mariner out on the open seas and you're looking at your charts where you've been, thinking that's going to point you to where you're going. I mean, who knows? You could smash into a reef or an iceberg, or who knows? Maybe that's what the the Titanic navigators were doing. I have no idea. But charts are not the answer. You need to have a macro vision. My personal portfolio just recently hit an all-time record high because in that whole entire monetarist, zombie, frenzied, market pullback, I was buying because I understood the impact of rate increases were fiscal transfers. And I kept saying, like anyone who's been following me for any length of time, I kept saying we were going to come to an inflection point, and I pointed it out last October. I said this is our inflection point where the transfers, the interest transfers to the economy are going to exceed the negative impact of the rate hikes. I mean, what more do I have to say? I mean, I'm giving you exact points, just like I'm saying right now. This drain is going to result in a pullback, and then you want to buy into this. I mean, it's going to be a slow growth economy, but that's not bad for the stock market. It just means it's going to go up at a slower pace. I don't know what else you want me to tell you. I mean, I'm giving you every freaking next move. It's like a chess game where I know exactly what the opponent is going to do next, and just like, so I'm going to win every game. There might be points in the game where it looks like I'm losing, but I see like 10 steps ahead. All right, listen, everybody, enjoy your Friday. If it's Saturday for you, enjoy your Saturday. And maybe I'll do another video tomorrow. Take care, everybody. Love you. Bye.